All right, let's now go even deeper. I'll explain every line again, but in more detail and super easy English, as if I'm teaching a curious 7-year-old. You'll fully understand everything like a pro, step by step. Part 1, disapproval of policy cut. What is it? Let's say the government wants to do something big, like building new schools, fixing roads, or buying planes for the army. To do this, the government needs money. So they ask the parliament, please give us 1,000 crores for this plan. This request is called a demand for grants, but sometimes members in parliament don't agree with the plan. They feel the plan is bad or the money is being wasted or a better plan should be used. So they say, we will give you only 1 instead of 1,000 crores. This is called a disapproval of policy cut.
Why only 1?
It's not really about the amount. 1 is just a symbol. It's like saying, we completely disapprove of your plan. We don't like it at all. They are not trying to save money. They're trying to say your idea is wrong. Can members suggest a better plan? Yes, this is not just about saying no. The members can also say, your plan is bad. Here's a better one. For example, if the government wants to build a fancy airport in a village, the member might say, that's not useful. Why not use that money to build hospitals instead? So in simple steps, 1, government asks for money. 2, some members don't like the policy. 3, they say, we'll give you only 1. 4, that shows disapproval. 5, they can also suggest a new plan. So imagine in school, the principal asks them to buy 500 balloons for a school party. But a teacher says, no, that's not a smart idea. Let's give only 1 and use the rest of the money to buy books for poor kids. That's a disapproval of policy cut, saying not just the Part 2, guillotine. What is it? In Parliament, the government gives a budget. The budget is a huge plan showing how much money the government wants to spend on schools, roads, police, army, health, and more. Now, all members of Parliament are supposed to talk and debate about each part of the budget, but sometimes there isn't enough time to talk about every little thing. Also, sometimes the opposition parties, those who are not in power, are very angry and talk too much or delay the process. So the Speaker, the head of the Parliament, like a teacher in class, says, no more talking. We will now vote on all the remaining things, one by one or all together, without discussion. This is called a guillotine. What does the guillotine do? It stops the debates. It saves time. It forces a vote. It's like the Speaker saying, we are running out of time. Just say yes or no, but no more talking. Why is it called a guillotine? A guillotine is a sharp blade used in old times to cut something quickly, like cutting off heads. In Parliament, it means cutting short the time to discuss the budget. So when you say guillotine, think, cut the talk, let's vote now. Why does the government use it? Sometimes the government knows the opposition will argue too much. The Parliament will take too long. People will start criticising their budget plans. So the government tells the Speaker, please use guillotine and finish it fast. Yes, because if members are angry and vote no, that vote may become a no confidence motion. This means we don't trust the government anymore. And if that happens, the government may fall. They might have to resign. But has it ever happened in India?
No.
No. So far, even though guillotine has been used many times, it has never made a government fall in India.
Why not?
Because India uses the British system of parliament. In this system, the majority party usually supports its own budget, so they win the vote even without debate. So guillotine becomes a shortcut, but it's still safe for them most of the time. Simple story example of guillotine. Imagine in class, there's a list of 20 students who want to say their opinion on a school trip, but time is running out and 10 students are still waiting. The teacher says, no more talking. Everyone just raise your hand, yes or no, for the trip. That's guillotine, cutting short the talk and going straight to the decision. Final simple summary, disapproval of policy cut. Parliament shows it doesn't like a government's plan. They reduce the money to just one plan to show disapproval. It's about saying no to the idea, not the money. Members can also suggest better plans. Guillotine, the Speaker says. No more talking, let's vote now. This helps save time when Parliament debates too long. It can be risky because it might look like a vote of no confidence. But so far it has never made the government fall in India. Absolutely. Let's go step by step, line by line, and explain everything about this topic in the most simple, easy and clear way, like you're learning it for the very first time. Let's begin. Topic: public debt, national debt. Line 1. Public debt is the total loans of the government of a country. Public means government. Debt means loan or borrowed money. So public debt means the total money that the government has borrowed from different people or groups. Why does the government borrow money? Just like people need money to buy things, the government needs money too. Build roads, run schools and hospitals, help the poor, pay salaries, defend the country, army, police. Sometimes the money the government gets from taxes is not enough, so it borrows money. From where does the government borrow? The government can borrow from Indian people through bonds, Indian banks, other countries, big international groups like World Bank or IMF. 2. Since this government is national, at times this is also called national debt. Because the government is for the whole country, it is called national debt, public debt, most of the time. Line 3. But in broader sense, the concept of national debt includes the non-government debt. Sometimes when people say national debt, they also mean loans taken by state governments, loans taken by government companies. So in that wider meaning, national debt equals central gov loans plus state public sector loans. Now about the rules for borrowing. Line 4. While the Union Government of India is mandated to borrow inside and outside the country the amount specified by the Parliament, Article 2 in 92, Union Government equals central government rules all of India. It can borrow money from inside India, from outside India, like foreign banks, countries, but the Parliament must allow it. This rule is in the Indian Constitution, Article 292. So, central government needs Parliament's permission to borrow money. Line 5. States are mandated, Article 293, to borrow only inside the country. State governments, like Kerala, Gujarat, Punjab, borrow money, but only from India. They cannot go to other countries to take loans directly. This is written in the Constitution in Article 293. Line 6. Beginning the financial year 2005-06, states were given access to external loans also, on the recommendations of the 12th Finance Commission 2005-10, for which sovereign guarantee is given by the centre. Before 2005, states could not take money from foreign lenders. But starting from 2005-06, a new rule came in. States could take foreign loans, but they needed the central government's permission, and the central government gives a guarantee. This is called a sovereign guarantee, a promise that if the state cannot repay, the centre will help. Line 7. While the general category states get external loans on a back-to-back basis, i.e. cost of interest and risk of exchange rate fluctuations borne by states, there are two types of states. General category, richer or bigger states, like Maharashtra, Tamil Nadu. Special category, poorer or hill states, like Himachal Pradesh, Assam. For general category states, if they take loans from outside India, they have to pay the interest, extra money paid for loan. If the exchange rate changes, like $1 becomes more expensive, the state bears the loss. This is called back-to-back loan. Centre takes the loan, but gives it to the state exactly as it is, with all its cost and risk. Line 8. The special category states get from the centre in the combination of 90% loan and 10% grant. For special category states, the centre helps more. If they take a foreign loan, the centre gives it like this. 90% loan, this they have to repay. 10% grant. This is free money. They don't need to pay back. So centre makes it easier for poorer states.
Final super simple summary term meaning public debt.
Total loans taken by government, union govt, can borrow in India and from outside with Parliament's okay. State govts can borrow in India, can borrow from outside, only with centre's guarantee. Rule for centre's borrowing. Article 293, rule for states borrowing. Back-to-back loan. State takes full cost and risk of foreign loan. Special category states get 90% loan plus 10% free money from centre. Simple example to remember. Imagine India is a big family. The father, central borrow from Indian friends or even foreign banks. The children, state govts, can only borrow from Indian people. But if children want to borrow from foreign banks, the father has to sign a paper saying, I will help if they can't pay. If the child is strong and rich, the father says, you handle the full cost. If the child is weak or poor, the father says, don't worry, I'll give you 10% free. Would you like a simple diagram or cartoon story to help you remember this better? I can also quiz you gently to help it stay in your mind. Absolutely. Let's go even deeper and make this super simple, like you're 5 years old, and I'm the world's best teacher sitting next to you with a smile, ready to explain every word with care. Main topic, public debt of India. Let's understand what this really means in the easiest words ever. What is public debt? Public was related to the country or the government. Debt equals borrowed money. So public debt means the money the government of India has borrowed and has to pay back later. Think of it like this. Imagine the government is like a person who needs money but doesn't have enough. So they go around borrowing from people inside India, people outside India, people who gave them money told temporarily. Let's now see the full picture step by step. 3 types of government borrowing liabilities. The Indian central government's loans or borrowings are divided into 3 parts. Think of them as 3 money jars. Cat 1, internal liabilities. Internal for inside India. Gov borrows money from Indian banks, people and companies. 2, external liabilities. External equals outside India. Gov borrows money from other countries, foreign banks and international organizations like the World Bank. 3, public account liabilities. This is not really a loan. It's money given by people to the government to hold safely, like Provident Fund, money saved by workers, small savings. The Gov uses it for now, but must return it later. Now let's focus on public debt. The term public debt only includes internal liabilities, external liabilities. It does not include the public account money. So we're only looking at actual borrowed money that the government must repay with interest. Let's deeply understand the internal liabilities. Now we go inside this internal loan jar and see how the government borrows money from inside India. They use 2 big ways called instruments. Hat 1, dated securities, GSECs. Let's understand every word. Dated equals they have a specific start and end date. Securities, documents that show someone has lent money. GSECs equals short for government securities, like loan papers from the government. What happens? The government says, hey, people of India, if you give us money now, we will give you regular interest and return your full money later. Example, you give the government 1,000. They say, we'll pay you raise 50 every year, and after 10 years, we'll give back your full raise 1,000. This is called a fixed coupon bond. The interest, 50, is fixed and given every year. Key points. Time can be short, medium, or long. Short, 1 years, medium, 4 to 7. Very safe investment, used by banks, companies, and big investors, dig investors too. Why is it important? Because more than 90% of the government's borrowings are through GSECs. Nash stuff 2, treasury bills, T-bills. Let's break this down simply. T-bills equals short-term way for government to borrow money quickly. Zero coupon, no yearly interest. Issued at discount, you pay less today. Redeemed at face value, you get full value back later. Example, you give the government Rs 950 today. After 91 days, they give you back Rs 1000. So you earn 50 without any interest payments during the time. This is used for very short-term needs. T-bill time durations, 91 days, 182 days, 364 days. What's the difference? Featured GSEC T-bills, type loan paper with fixed interest, short-term no interest loan. Interest, yes, paid every 6 months, year, no regular interest. Duration 1 year to 30 years, less than 1 year, 91, 181, 382, 364 days. Who buys? Banks, companies, people. Risk, very low, safe, very low. Quick visual example. Imagine this. You're the government. You need money for building roads, schools, etc. You ask, give me 1,000 and I'll pay you raise 50 every year and return full money after 10 years. That's give me raise now, I'll return 1,000 in 3 months. That's how from inside the country. Would you like me to external debt and public account in the same deep step-by-step way next? Or one quiz story to test your understanding? Absolutely. Let's now explain this even more deeply, but still in the most simple, slow and clear way, as if I'm teaching a young child who has no idea about any of this. I'll use easy words, real life examples, and break it all line by line, word by word, so nothing is confusing anymore. We are learning about 2 things. 1, 14-day T-bills. 2, securities given to international financial institutions. 1, 14-day Treasury bills, T-bills. What is a Treasury bill? T-bill. A T-bill is a way for the government to borrow money for a short time. It gives someone a small piece of paper called a security that says, please give me money now, I'll return it later with a little extra. That extra is the interest, the reward for lending money. What does 14-day T-bill mean? The number 14-day means the government borrows money for only 14 days, 2 weeks. After 14 days, the government gives back the money. Example, you ask your cousin, can you lend me 100 for 2 weeks? I'll return 103. That's just like a 14-day T-bill. What does non-transferable mean? It means once you buy it, you can't sell it or give it to anyone else. You have to hold on to it until 14 days are over. Example, if your name is on a concert ticket, only you can go. You can't give it to someone else. That's non-transferable. Who can buy these 14-day T-bills? Only state governments like Kerala, Gujarat, etc., foreign central banks, big banks of other countries, and other special big institutions decided by RBI. Important, you and I, common people, can't buy them. These are only for big official bodies. Why were they started in 2013? Earlier, the government could borrow money anytime it wanted from the RBI, like an open tap of water. But that system was closed or phased out. So in 2013, RBI created this 14-day T-bill system to help the government borrow for a short time when it urgently needs money. What are ways and means advances? This means the government sometimes runs low on cash, like how we may run out of money before our next salary. In those times, it borrows small amounts for a short time to keep things running. This is called Ways and Means Advances, WMA. 14-day T-bills help cover this temporary gap. What interest is paid on these T-bills? Interest is 3% lower than what the government pays on 91-day T-bills, which are T-bills for 3 months. Example, let's say the 91-day T-bill gives 6% interest. Then the 14-day T-bill will give 6%, 3%, 3% interest only. Because it's for a short time, the government pays less extra money. Interest. 2, securities given to international financial institutions. What are securities? Think of them like promises on paper from the government. We owe you this amount. This is our official promise to pay you. It's like you write an IOU to someone. I will give you Rus 100 later. Who gets these securities? Big world banks that help many countries, such as IMF, International Monetary Fund, World Bank, Asian Development Bank, ADB. These are like global money clubs. Countries like India join these clubs and contribute money to help the world. Why does India give them securities instead of cash? Instead of giving actual cash, India sometimes gives these securities, IOU type papers. It's like saying, here is our share. We promise to pay this amount. Use this paper as proof. That's easier for the government than giving huge amounts of cash. Why does India contribute to these institutions? Because being a member means India can borrow from them during emergencies. India gets help for big development projects. India gets a voice in world money decisions. So it's like we're all part of one big club. We each pay our part so we can all help each other when needed. In short, term, simple meaning, easy example, 14-day T-bill. Govt borrows money for 2 weeks, like you borrow arse. 100 for friend and return in 14 days. Non-transferable. Can't give or sell to others. Like a movie ticket with your name. Only big buyers. Only states or foreign banks can buy. Not for normal people. 3% lower interest. GovT pays less for short loans, short time or less reward. Securities to IMF, etc. Promise is given instead of cash, like saying I'll pay later instead of paying now. Would you like me to draw this in a cartoon or tell it as a story with characters? Like Guft Uncle borrowing from Bank Auntie, or turn it into a quiz or song to help you remember? Of course. Let me now explain this entire topic again, in even greater detail and in the simplest, most beginner-friendly way possible. Imagine you're a curious child who has never learned about money, savings, or borrowing before. I'll explain everything step by step, word by word, using very easy words, real-life examples, and a super clear structure. Topic: Public debt of India explained like a story. First, what is public debt? The word public means for everyone or by the government. The word debt means borrowed money, money you take now and promise to pay back later. So public debt means money that the government of India borrows and has to pay back later. The government borrows money when it doesn't have enough money to pay for things like roads, railways, hospitals, schools, salaries of government workers, and more. Now, let's break the public debt into two parts. 1, internal debt inside India. 2, external debt outside India. Let's understand both clearly. Part 1, internal debt, borrowing from inside India. This means the Indian government borrows from Indian people and institutions. Now, how does the government borrow this money? It sells special papers called securities. These papers say, give us your money now. We'll return it after some time with interest. These papers are of different types. Let's learn the types one by one. A, dated securities, also called GSECs, called government securities. These are papers like loan slips the government sells to people or banks. Each paper has a fixed time and fixed interest rate. Time can be short, 1 year, medium, 5 years, or long, 10 plus years. Example, you give Rs 1,000 to the government. They promise we will return it in 5 years. Every year we'll give you Rs 80 as interest. So this is like a loan you give to the government. They use it now and give back more later. B, treasury bills, T-bills. These are short-term papers, less than 1 year. Government sells them at a discount and buys them back later at full price. Example, you buy a T-bill for Rs 950. After 3 months, the government gives you Rs 1,000, so you earned Rs 50. There are 3 types of T-bills: 91 days, about 3 months, 182 days, about 6 months, 364 days, about 1 year. C, 14-day T-bills. These are very short-term loans, just 14 days, not for normal people, only for state governments, foreign banks, some special bodies. Interest is lower than regular T-bills. D, securities issued against small savings. Let's break this down simply. What are small savings? These are the money people save in government savings schemes like Post Office, Public Provident Fund, PPF, Sukanya Samriddhi Yojana, Senior Citizens Scheme. All this saved money goes into a fund called SSF, National Small Savings Fund. What does the government do with this fund? When people take out their money equal withdrawals, the money left in the fund equals net balance. Government borrows this leftover money and issues special securities, loan papers. In simple words, government uses people's small and gives them a promise to return it later. Securities to international financial institutions. Sometimes India needs to put money into global banks like World Bank, IMF, International Monetary Fund, ADB, Asian Development Bank. India gives them money by issuing security as proof of payment. Part 2. Debt. Borrowing from outside India. This is when the central government borrows money from other countries or world banks. This money is used for building big dams, metro rail projects, climate work, infrastructure. Who gives this money to India? 1. IMF, International Monetary Fund. 2. World Bank. 3. ADB, Asian Development Bank. 4. Sovereign funds, government-owned money funds from rich countries. 5. Other countries like Japan, USA, Germany, etc. Types of external loans. A. Multilateral loans given by group banks like IMF, World Bank, ADB. Example, IMF gives 1,000 crore to India for building better health systems. B. Bilateral loans given by one country to another. Example, Japan gives India money to build bullet trains. Important note, only the central government, union government, borrows from outside. State governments are not allowed to take loans directly from other countries. Final summary, easy table, part of public debt, where borrowed from, type of papers given to, borrowed from, type legally from other countries. Internal debt, inside India, G-Secs, T-bills, etc. Indian banks, public, NSSF. External debt, outside India, loan agreements, bonds, World Bank, IMF, Japan, etc. Super simple life analogy. Imagine India is like a big family. The family saves money in piggy banks, small savings. The parents borrow some money from kids' piggy banks and promise to pay later, internal debt. They also borrow from rich neighbours like Uncle Japan or Aunt USA, external debt. Let me know if you'd like a colourful chart or diagram, a fun story with characters, a video script, or more examples to make this 100% unforgettable. I'm here to be your best teacher. Absolutely. Let me now teach you this in the most simple, word by word, line by line way, like I'm teaching a total beginner, even a small child who has never heard of debt or government before. Topic, adjusted debt, explained like a story for beginners. First, what does debt mean? Debt simply means money that you borrow and have to return later. When the government of India spends more money than it earns, it borrows money. This is called public debt. Now, what is adjusted debt? Let's break it down very slowly and clearly. In 2010, the government introduced a new idea, adjusted debt. This is just a smarter and clearer way to look at government debt. It's like cleaning up messy numbers to see the real picture of how much the government owes. Why do we need adjusted debt? Let's say you borrowed Rs 10 from your friend, but you already had Rs 3 in your piggy bank that you forgot. Also, your little sister also owed you Rs 2. So to know your real debt, we must remove those extra Rs 5. Real debt equals 10 to 5 equals Rs 5. Just like that, the government also does some adjustments to find its true debt. So what gets adjusted? Look at each part, line by line. Number 1, external debt at current rupee exchange rate. India borrows money from other countries in dollars, yen, etc. But in India we use rupees. So the value of the debt changes depending on how strong or weak the rupee is. Example, if 1 equals 50, then a $100 loan equals 5,000. If $1 equals 80, then the same $100 loan equals 8,000. So the adjusted debt shows the amount after converting foreign loans into rupees using the current rate. 2. Minus Market Stabilization Scheme, MSS. This was a scheme where the government borrowed money but didn't spend it. It was only used to control too much money in the economy. Important, since the money wasn't used, it shouldn't be counted as debt used for real work, so it is removed from the final debt. Note, this MSS scheme was abolished, stopped in 2014. And 3, minus NSSF money not used for central gov to deficit. NSSF called National Small Savings Fund, where your small savings like PPF, Sukanya, etc. go. If the government didn't actually use this money to cover its shortage deficit, then it shouldn't count as real debt. So that part is also removed. Summary so far: adjusted debt equals total debt, external debt converted at current rupee rate, unused MSF, unused NSSF money. This gives the true and cleaned up picture of what the government really owes. Next, what about general government debt? This means adding the debt of the central government plus all state governments. Now, if we just add both directly, there's a problem. We might count some things twice, so we remove these two things. 1, short of 14-day T-bills held by states. These are like short-term savings of state governments, but this is also counted as central debt, so we remove it once to avoid double counting. 2, loans from centre to states. If the central government gives a loan to a state, it shows as debt for the state and asset for the centre, so we remove this loan from the total. What's the goal of all this? To know the real exact amount of debt India truly has, without duplication, confusion or error. Reports for transparency. To keep things honest and clear, the government releases 1, quarterly report on public debt. Every 3 months, like a school report card, shows how much the government borrowed and paid. 2, annual status paper on government debt, started in 2010-11, released every year, tells what debt was taken, how healthy India's debt is, whether the debt is under control. Uses global standards to measure and compare. Super simple analogy. Imagine your parents borrowed money from a friend in dollars, from you, from your piggy bank, and from grandma only for show, didn't use it. Now to find the real debt, they convert grandma's dollars into rupees, subtract your piggy bank savings not used, ignore grandma's money not spent. Only then they know what they really owe. Final simple summary. Simple meaning adjusted debt, cleaned up version of total debt, external debt, loans from other countries, changed to rupee. MSS, borrowed money not spent, removed from total. NSSF, small savings fund, only used part is counted. General government debt, total debt of centre plus states with overlaps removed. Status paper, yearly report card of India's debt. Would you like a diagram, flowchart or memory trick to remember this easily? I'm happy to make it fun. Absolutely. Let's explain independent debt management in even more detail, word by word, step by step, with super simple examples and clear logic, like I'm teaching a 10-year-old with zero background. I promise you'll understand everything by the end. What is debt? Let's start at the root. Debt means borrowing money that you will pay back later, usually with interest. Example, if you ask your friend for 100 to buy a toy and you promise to return 110 after 10 days, that 100 is your debt. And what is government debt? Just like people borrow money, the government also borrows money when it doesn't have enough for spending. The government borrows money to build roads, bridges, schools, pay salaries, run trains, hospitals, etc. This is called public debt or government debt. What is debt management? It simply means taking care of all the money the government has borrowed, like how much to borrow, when to borrow, from where to borrow, at what interest rate, how to pay it back. It's like having a planner or manager for government loans. Who manages the government's debt today, as of now? Right now, it's done by the RBI, Reserve Bank of India. Is India's central bank that controls money rules in the country. So RBI borrows money on behalf of the government, sells bonds to raise money, plans when to borrow and repay. But some people think this is a problem. Why? Let's go point by point, very slowly. 1. Conflict of interest. RBI does two big jobs at the same time. Job A, RBI sets interest rates, called policy rates. This decides how expensive or cheap loans are in India. Job B, RBI also borrows money for the government by selling government bonds. Problem, it's like being both the referee of a football match and a player in the same team. That's unfair, right? That's called a conflict of interest. Example, imagine a teacher who sets the exam question paper and also writes answers for one student. That's unfair. 2. Global versus Indian loans mismatch. In the world today, money moves across countries easily. India borrows not only from Indians, but also from other countries, called external commercial borrowings. Indian borrowing domestic market is controlled by RBI's interest rates. Foreign borrowing depends on global interest rates, like US or Europe rates. This creates a gap, a mismatch. Example, RBI interest rate equals 7%. US interest rate equals 2%. Obviously, companies and even the government may want to borrow from the US. It's cheaper. So India's borrowing is getting more international, but we are still fully controlled by RBI. That doesn't fit well anymore. 3. Need for a separate expert agency. So some experts said, let's create a new team called Public Debt Management Agency, PDMA. Their job would be only manage government debt, decide how to borrow, from where and when, think only about getting the best deal for government borrowing. No conflict of interest. When did this idea come? 2015, the government said in the budget, let's create PDMA, but RBI disagreed, so the plan was stopped. 2019, Niti Aayog, a policy advice group, again said, now is the right time. Let's make this happen. Why RBI didn't want to give up debt management? RBI may have thought, we've been doing this job well for years. If we lose this power, we lose control over one part of the economy. But still, experts argue, it's better to separate roles, so there's more focus, more fairness, and better planning. Final super simple summary. The government borrows money. Right now, RBI manages this debt, but RBI also sets interest rates which affect loans. This is a conflict of interest, like being a player and a referee. India's borrowing is becoming more global, and a separate team, PDMA, is needed to manage it better. Experts say, let RBI do its job, monetary policy. Let a new agency do the borrowing work. The idea was started in 2014 and then again discussed in 2019. Do you want a chart, a comic strip version on this? Just say yes, and I'll make it even more fun. Here's a great detailed summary of the explanation above, like I'm telling a story to someone with no background in economics. Summary, central government's debt, easy explanation. What is it? The central government of India borrows money to run the country, to build roads, pay salaries, run schemes, etc. This borrowed money is called the government's debt. Where does the borrowed money? The money borrowed by the government is kept in two main places. One, consolidated fund. This is the main account of the government. All tax money and borrowed money goes here. The loans taken and kept here are called public debt to public account of India. This holds money the government temporarily keeps for others, example, money from pension funds, savings schemes, etc. The government must return this money one day. Does the government borrow from other countries? Yes, this is called external debt. But India borrows very little from foreign sources. Most of the borrowing is from within India. What about the NSSF, National Small Savings Fund? People save money in government schemes like PPF, NSC, etc. This money goes into the NSSF, but not all of this is counted as the central government's debt because some of it is borrowed by state governments, some is invested and doesn't add to the centre's deficit. Debt in numbers as of March 2019. Total debt, 84.7 lakh crore. 90% of it is public debt through the consolidated fund. Debt as percent of GDP was 45% in 2019-20, down from 55% in 2004-05. This drop shows better control on borrowing thanks to the FRBM Act. Why is India's debt considered safe and low risk? 1. Very little foreign borrowing, so currency risk is low. 2. Fixed interest rates on most loans. The amount to be paid doesn't change with rising interest rates. 3. Long time to repay. Government is now taking longer-term loans to repay quickly. This reduces rollover risk, the risk of needing a new loan to repay an old one. Bonus point, FRBM Act helped a lot. FRBM equals fiscal responsibility and budget management. This law pushed the government to borrow less and manage money better. Because of this, debt is falling over time and economy is growing. Final picture. Think of the Indian government like a parent managing a huge home. They borrow money when needed, but use it wisely. Keep it in the right accounts. Borrow mostly within the family. India? Return the money slowly and safely. This careful behavior is what makes the debt manageable and low risk. Let me know if you want a diagram, a flowchart, or a quiz to remember this better. Absolutely. Let's now dive even deeper and break down every part of this in an even more detailed step-by-step summary using the simplest, clearest words, like you're learning from the world's best teacher who's guiding a total beginner. Super detailed summary. Government of India's debt as of March 2019. 1. What is debt or liability? Money, it becomes a liability. Something it has to pay back in the future. Think of it like when someone takes a loan, they have to repay it with interest. For the government, these borrowings are to fund expenses like building roads, paying salaries, running schools, etc. 2. Types of government debt. There are 2 main categories. A. Public debt, 90% of total debt. This is money central government directly from people through bonds, banks, other institutions. It's borrowed through the Consolidated Fund of India, the main bank account of the government. It's like a formal loan with clear rules. B. Other liabilities, 10%. These are money kept in special accounts like Public Provident Fund, PPF, employees' savings, other small savings. These are under the Public Account of India, a separate fund. Government uses this money temporarily and must return it. And that's 3. External debt. Some of India's loans are taken from foreign countries or organizations like World Bank, Asian Development Bank. This is called external debt. But this is a very small part of India's total debt. Plus, these loans come from trusted official sources, not private risky sources. 4. Special note on NSSF, National Small Savings Fund. People deposit their savings in schemes like PPF, NSC, etc. This money goes into NSSF. Sometimes states borrow from this fund. If that money is used by states or invested, not spent by centre, then it is not counted as centre's debt. Example, imagine a piggy bank shared by centre and states. If the centre didn't touch that money, it won't be fair to say the centre borrowed it. 5. Total liabilities of the central government as of March 2019. The total debt was 84.7 lakh crore. Out of this, 90% was public debt borrowed directly by the centre. Debt to GDP ratio. What's that? GDP, gross domestic product, is the total income of the country in 1 year. Debt to GDP ratio means how much money the government owes compared to how much the country earns. Changes over time, 2004 to 05, 55% very high. 2015, 46.5%, 45% better. Why is this important? A lower ratio means the country is in better financial health. It shows the government is managing its money well. 7. Why has the ratio fallen? 2 main reasons. 1, fiscal consolidation. The government is borrowing less and trying to spend wisely, like a family making a strict budget to avoid too much loan. 2, high GDP growth. India's economy is growing faster, so even if debt grows a bit, income grows faster. Just like if your salary increases every year, even a small loan won't feel too heavy. Nature 8. Is this debt dangerous or risky? Not much. Here's why. A. Low currency risk. India's foreign debt is very low, so if the rupee value changes, it doesn't affect us much. B. Low interest rate risk. India takes loans at fixed interest rates, so if interest rates increase in the market, the government still pays the same fixed amount. It avoids surprise extra thing. What is rollover risk? It means the risk that the government has to take a new loan just to repay an old loan. If too many loans come due, mature in a short time, rollover risk is high. But in India's case, maturity is long-term. Loans now have a longer duration. In 2010, average loan had to be repaid in 9.7 years. In 2019, that average became 10.4 years. Fewer short-term loans. Very few loans are maturing in the next 5 years. That means the government has more time to plan repayments. Final thoughts. India's debt is big in number, yes, but not dangerous because government is managing it well, borrowing mostly from within the country. Loans are at fixed interest rates. Loans are for long terms. GDP is growing fast. FRBM law is helping control it. Would you like a visual infographic, mind map or flashcards based on this too? Or should I turn this into a simple mock test for practice? Sure, here's a great detailed summary of the topic, central transfers to states, explained clearly, thoroughly, and in the simplest possible way so that anyone, even with no background, can fully understand. Detailed summary, central transfers to states in India. 1. Why states need central support. States have less money than the central government, but they have to spend on many important things. Education, health, roads, water, agriculture, disaster relief, and more. So states are often under pressure to find enough money to do all this. Therefore, the central government transfers money to the states to help them function properly. 2. How this problem was solved. The Finance Commission, a constitutional body set up every 5 years, looked at this problem. It recommended more money should be given to states to make the system fair. This was done by giving states a bigger share of tax revenue collected by the centre, called devolution, providing extra funds, grants in aid, money given freely to help with special needs. This move was progressive, meaning it helped states become stronger and more independent financially. 3. What changed during reforms? After the 1991 economic reforms, all ways to collect their own money. These new tools included ability to take loans, better tax systems, public-private partnerships, attracting businesses and industries. But this also came with increased responsibilities. States had to do more, and transparency. They had to show clearly how they used the money. Number 4. States still face fiscal pressure. Even with these improvements, states still struggle. Reasons include high expenses, salaries, subsidies, social programs, slow tax collection, natural disasters, political promises, free electricity, etc. So the central transfers are still very important to help states meet their needs. Flash 5. Main ways the centre transfers money to states. There are 3 main types of transfers, excluding a few other small ones. Share in central taxes, devolution. The census from all over. A part of this total tax money is given to states. The Finance Commission decides the percentage, e.g. 41% of total divisible taxes in recent years. Grants from Finance Commission. These are extra money given to states that are poor, have special needs like disasters or less development, need support for health, education, etc. These are not loans. States don't have to repay them. Centrally sponsored schemes, CSS. These are programs started by the centre, but implemented in the states. Funding is shared. Centre gives the major part, states give a smaller part. Examples: Swachh Bharat Mission, Midday Meal Scheme, PM Awas Yojana, Housing, National Health Mission. These programs are meant to ensure that important services reach the people, even in poor or remote states. 6. Other types of transfers. Besides the above 3, the centre sometimes gives us additional central assistance, ACA, for special projects, special central assistance, SCA, for backward areas or specific groups. Our final words. The centre-state financial relationship is crucial for balanced development in India. The centre helps states through tax sharing, grants, joint schemes. This system makes sure that all states, whether rich or poor, can function and provide services to their people. Would you like this summary as a visual infographic, notebook-friendly PDF, or with real-world examples from recent years? I can do that too. Of course, let's go even deeper and explain everything in the most simple and detailed way, like teaching a curious child. Topic: State Finances 2019-20. This is all about how much money Indian states earned and spent in the year 2019-2020, April 2019 to March 2020. 1. States are on the fiscal glide path. Very simple meaning. The Indian states were trying to manage their money carefully and slowly. They had a plan to reduce debt and not spend too much, just like how an airplane glides down slowly before landing. Example: imagine your parents say, from now on we'll spend less and save more. That's a glide path, a plan to control money carefully. But in the past few years, they have felt increased fiscal pressure. Simple meaning, but in the last few years, states have started feeling money stress. They are having a hard time managing their income and expenses. Your parents tried to save and expenses went up, so they're now worried. 3. Fiscal constraints have been caused by several microeconomic factors. Very easy meaning, there are some small level micro problems in the economy that are making it hard for states to manage their money. 4. Microeconomic problems. Let's by one. A. Falling tax revenues. Meaning, states are collecting less money from taxes than before. Why is this bad? Because taxes are the main income of states. Example: if fewer people are shopping, then GST, tax on goods, will be less. The government gets less money. B. New policy actions like farm loan waivers. Meaning, the government cancels the loans that farmers took from banks. This helps the farmers, but now government pays the banks. Problem: this costs a lot of money for the state. Example: imagine a school says no student needs to pay their fee. The school now needs to find money from someone to pay teachers. Chassis: direct income support to farmers, meaning the government gives cash directly into the farmers' bank accounts to support them. Problem: this also increases the state's expenses. Example: if your parents give pocket money to everyone in your colony, they'll need a lot of money and they may not have enough. 5. Tax revenue. As per 2019-20 budget estimates, the government made a budget plan for the year 2019 to 2020. In that plan, then, they guessed how much money they would earn. #6. It's combined expected to grow at 11.1%. Own tax revenue equals taxes collected directly by the state, like sales tax, property tax, excise duty on alcohol, etc. Expected to grow by 11.1%. If they earned 100 last year, this year they expected to earn 111. But this is less than last year's growth. Last year, the growth was even stronger. 7. Own non-tax revenue is expected to grow at 9.9%. Non-tax revenue equals money from other sources, not from taxes, like fees for services, like driving licenses, money from electricity boards, rent from government buildings, etc. Expected to grow 9.9% equals. If they earned 100, now they expect 109.90 cents. Again, this growth is slower than last year. Full final summary in very easy words. Indian states were trying to handle their money carefully, but in the last few years they faced money problems. These problems happened because they were getting less money from taxes, but were spending more money to help farmers, like waiving loans and giving money directly. In the year 2019 to 2020, states expected about 11% growth in tax money, about 10% growth in other earnings. But this was slower than the strong growth in 2018 to 2019, so the financial pressure on states increased. Would you like a chart, short notes or flashcards version of this too? Here's a great detailed summary of the passage on state finances in India 2019 to 20, written in simple, clear language with all important points. Detailed summary, state finances in 2020 states. In 2019-20, Indian states plan to increase their total spending by 8.4% compared to the previous year. This spending growth was mostly because of an increase in revenue expenditure, 9.4%, while capital expenditure, which is used for building things like roads, schools and hospitals, would grow only by 3.2%. What is it? Revenue expenditure is used for day-to-day expenses of the government. It includes salaries, pensions, interest payments on loans, etc. These are committed expenses, meaning states are required to pay them every year. This kind of spending doesn't help in creating assets or infrastructure. What is capital expenditure? Capital expenditure is money spent on building new infrastructure, like roads, bridges, hospitals, power plants. It creates long-term assets and helps boost economic development. 4. Rising revenue expenditure equals a problem. Since states are spending more on revenue and less on capital projects, it can slow down future development. The RBI, Reserve Bank of India, warned that this decline in capital spending may harm the quality and speed of economic growth. 5. Fiscal deficit. Are states managing it? Fiscal deficit means when states spend more money than they earn. The states are following the rules of the FRBM Act, Fiscal Responsibility and Budget Act, which sets a limit on how much they can borrow. For 2019-20, it's expected their combined fiscal deficit to be 2.6% of India's GDP, which is within the safe limit. 2018, 2.4%. 2018-19, 2.9%. 2020, 2.6%. 6. How are states borrowing money? States borrow money to cover their fiscal deficit. Over time, states have increased their reliance on market borrowings. In 2016, 61.6% of their borrowing was from the market. In 2018-19, 73.7%. In 2019-20, estimated to be 87.9%. Market borrowing means selling government bonds to the public and investors to raise money. Key takeaways. States are spending more, but not enough on development projects. Most spending is on fixed obligations like pensions and interest. Capital investment is slowing, which can negatively impact growth. Fiscal discipline is being followed, and borrowing levels are under control. But states are increasingly dependent on market borrowing, which needs careful management. Let me know if you'd like this as a bullet point revision note, a diagram, a flashcard set, or even a story-style explanation. Happy to help however you learn best. Here's a great, detailed and simple summary of the topic on state debt, debt to GDP ratio and borrowing rules in India. Detailed summary, state debt and borrowing 2019-20. 1. What is debt to GDP ratio? It compares how much money a state owes debt to how much it earns in a year GDP. A higher ratio means the state is more burdened with debt. 2. Rising debt since 2014-15. In 2014-15, the debt to GDP ratio of all states together was 22%. By 2019-20, it had risen to about 24.9%. This means for every 100 a state earned, it owed nearly 20. Why did debt go up? 3 main. U-Day scheme 2015-17. To help power companies, states took on their losses by issuing U-Day bonds. This added significantly to state debts. 2. Farm loan waivers. States forgave loans taken by farmers. While helpful to farmers, this meant extra spending for states, causing more. 3. Commission. Government employees got higher salaries and pensions. States had to spend more money on this, so again they borrowed more. 4. Is this a problem? Yes. A rising debt-to ratio means states are and may face trouble repaying if not managed well. This makes debt sustainability, keeping debt at a safe level, a big challenge in the coming years.
Borrowing ceiling and rules.
5. What is the borrowing limit? In 2019-20, all states were allowed to borrow up to 6,11,186 crore in total. This limit was based on a rule. States should keep their fiscal deficit at or below 3% of their GDP. 6. Extra borrowing. Allowed with conditions. The 14th Finance Commission allowed extra borrowing up to 0.5% more, but only if states met certain conditions. To qualify, a state had to 1. Keep its debt to GDP ratio under 25%. 2. Ensure interest payments are below 10% of its total revenue. 3. Avoid revenue deficit, i.e. not spend more than it earns in regular expenses. If a state followed all these, the central government gave permission for extra borrowing. Conclusion. Indian states have been borrowing in recent years due to several welfare and salary-related expenses. This borrowing is raising their debt levels and could affect the future. The government tries to control this by setting borrowing limits and giving extra flexibility only if states are financially disciplined.
Let me know if you'd like.
A chart comparing year-wise debt, simple Q&A format, or bullet point flashcards for revision. I'll break it down however helps you best.